And yeah, I'll say that by too much aggression. That was a wonderful lesson. If you
So,
take your in a negative net worth territory, the scar tissue is very, very, very deep. And I have since then not once forgotten about the fact that markets work. That the cure for high prices is high prices, and the cure for low prices is low prices. But first of all, intellectual capital. If I am backing somebody exploring offshore Namibia for oil and gas, I want the management team to have experience exploring offshore Namibia for oil and gas. If their experience, if their prior success has been drilling shallow gas wells in Saskatchewan onshore, finally, I want to know what it is likely that a yes answer, what the next question that's predicated on a yes answer to the current question. Obviously, a long time ago, Danny. When I was a young man, I came into the resource business in 1970, which was the beginning of the most spectacular bull market, probably in recorded history. And being a young man, hubris-ridden, testosterone charged, although the gold price went from $35 an ounce to $850 an ounce, I thought I was making money because I was smart. I didn't understand that I had the wind in my sails. I thought I was a genius. That's the way young boys are. They want to believe good things about themselves, and so they do. And I didn't understand that markets work. I didn't understand how cyclical they were. It was useful to me because in the early part of my career, I was so aggressive. And my naked aggression made me outperform better investors who were more cautious. The zeitgeist of the 70s was the sort of Club of Rome, scarcity, which is to say that although the oil price went from $3 to $30, the Jimmy Carters of the world said that the oil price was going to go to $200 and that we were going to run out of resources. And that was convenient for me. I didn't understand that markets work. The consequence of that is that in 1981, 1982, when the resource markets broke, I was totally psychologically and financially unprepared for it. And I went from being a young, extraordinarily successful, extraordinarily wealthy, and by the way, extraordinarily hubris-ridden, arrogant young man, to having a net worth in negative territory, which is to say that I had bank leverage on my oil and gas production. And while the value of my assets was ephemeral, the value of my debts was money good. I went from having a high positive net worth to having a negative net worth. I was able to get out of that situation because I didn't believe that I had the right to go bankrupt. I believed that I had incurred those debts and I had an obligation to discharge them. And I was able to assemble my creditors in 1982, introduce them to each other, and say, if you give me time, although I don't have any money, I'm a very good earner. I will do my best to earn my way out of this. I'll do my best to make all of you whole. But if any of you press your bets, any of you individually could put me into bankruptcy. And if you do that, you'll jeopardize the ability of my other creditors to get whole. The consequence of that very forthright approach to my creditors allowed me to buy the time to pay back all my obligations. And in fact, of my 6 primary creditors, 4 of the 6 presented opportunities to me in the early part of the decade of the 80s, which I was able to act on, that greatly facilitated my ability to repay them. And 2 of the 6 creditors became my most important clients for the ensuing 40 years. So I hope that answers the question very thoroughly. I blew myself up by my lack of understanding that markets work, by my young male sort of preponderance or preference for hubris, and Yeah, I'll say that, by too much aggression. That was a wonderful lesson. If you
So,
take yourself into negative net worth territory, the scar tissue is very, very, very deep. And I have since then not once forgotten about the fact that markets work, that the cure for high prices is high prices and the cure for low prices is low prices. And that most of my competition is as inexperienced and hubris ridden and aggressive as I was. And now I deal with those youngsters, those competitors, very easily.
in the high-risk world of junior resource exploration, experience is not optional, it is foundational. Legendary investor Rick Rule emphasizes that expertise must match the specific challenge at hand. A team drilling offshore Namibia must understand offshore Namibia, not just oil and gas generally. Exploration, he argues, is an intellectual business disguised as a capital-intensive one. Technical precision, geological understanding, and region-specific experience determine outcomes. Without task-specific competence, even well-funded ventures can fail. In early-stage exploration, the difference between vision and illusion often lies in whether management truly understands the terrain they are attempting to conquer.
First of all, intellectual capital. If I am backing somebody exploring offshore Namibia for oil and gas, I want the management team to have experience exploring offshore Namibia for oil and gas. If their prior success has been drilling shallow gas wells in Saskatchewan onshore, while they may have been successful in oil and gas, they aren't successful at the task at hand. Exploration is more of an intellectual capital business than it is a physical capital business. And so I approach exploration technology the same way my friend Paul Stevens would explore technology in Silicon Valley. Specific expertise at the task at hand. The second criterion, I think, is scale. If I'm going to take a risk where the probability of success is 50%, the reward for success better be 1,000%. In other words, if I'm exploring, I don't want to explore for a tier 2 or tier 3 deposit. I want to explore for a tier 1 deposit. When my probability of success is low, the payoff that I need to achieve if I achieve success has to be high. I have in the gold business absolutely no interest in exploring for a 500,000 ounce deposit. I have an interest exploring for a 5 million ounce deposit. The probability that I succeed is low, but the payoff if I succeed is extraordinary. The third is that if you assume that I'm exploring for a tier 1 outcome, and I'm exploring for that outcome with a management team that has expertise that's relevant to the task at hand, I want a very, very, very clearly defined business plan. I want that management team to be able to describe for me the most important unanswered question around their investment thesis. I want them to explain to me what would constitute success, what would constitute failure, how long it will take them to get an answer, either a successful or an unsuccessful answer, because I want to calibrate the time I am expected to stay in the investment with the time it will require me to get a yes or no answer. And I want to know how much money it will cost to get a yes or no answer, and whether they have that much money. Finally, I want them to tell me, in the event of a yes answer, well, first of all, in the event of a no answer, what they'll do. And in the event of a yes answer, what do they think the next unanswered question is?
Exploration is inherently uncertain. Success rates can be low, sometimes below 50%. That reality demands extraordinary upside. Rule insists that if the probability of success is modest, the potential reward must be transformative. He is not interested in small discoveries. A 500,000 ounce gold deposit does not justify the risk. A 5 million ounce deposit might. In venture speculation, scale determines viability. Investors must pursue Tier 1 assets capable of delivering outsized returns. Without meaningful asymmetry, the risk-reward equation collapses. In volatile commodity markets, average outcomes do not compensate for high failure rates. Only exceptional discoveries justify exceptional uncertainty.
Finally, I want to know what it is likely that a yes answer, what the next question that's predicated on a yes answer to the current question. They may say, I don't know. They may say it depends on the data we get from the yes answer. And that's a fine answer. What I find, though, Danny, is that when I ask these people what the most important unanswered question is, over 40 years, 80% of the time when I answer that question, the management team says to me, I've never thought of it in that context, which is to say they don't have a plan. It's very difficult to get somewhere if you don't have a plan. It turns out that for most of the juniors out there, the most important unanswered question for them is, will I get my salary next year? And while I understand that that question is of value to them, it's of no value to me whatsoever. I want a process laid out to test the thesis. And I want that process to be sequential. And I want the management team to understand it. And I want me to understand it too. And I want that thesis, I want the methodology to test the thesis to be supported by the facts at hand, ground truth, not by narrative. And I want to trust the expertise of the people asking the question. Of equal importance, I want to know the time frame. Danny, as you know, I've graded almost 100,000 portfolios over 35 years. And I've noticed an amazing disconnect between the time that's necessary to own a speculation and the time that people are willing to own a speculation. If your thesis involves drilling in northern BC with a fairly narrow weather window, and your thesis might take 2 drilling seasons, what that means is likely it takes 18 months before you get a yes answer. If in your own mind you aren't prepared to own the stock more than 3 or 4 months, how are you reasonably going to have the expectation of getting a yes answer? In other words, your speculation is predicated on a time frame that you are unwilling to hold the stock for, almost a guarantee of failure. And I want to understand, again, let's use the example of a drilling program in northern BC. If it's going to take 18 months, and it's likely that my on-site expenditures are $5 million, and that my G&A is $2 million a year, what that means is there needs to be $5 million in exploration money and $3 million in G&A. In other words, there has to be $8 million in the company in order for them to have the money to get me the outcome that justifies the speculation. If a company doesn't have the money to get to a yes answer, how could I reasonably expect to get a yes answer? So if I'm not prepared to hold the stock for the period of time required to get a yes answer, and or if the company doesn't have the money to get me a yes answer, I can't own the stock. Mercifully, I'm competing against a universe of investors who haven't thought through the process as well as I.
Ambition without structure is speculation without discipline. Rule demands that management articulate their most important unanswered question. What specifically are they testing? What defines success? What constitutes failure? How long will it take to know? How much capital is required to reach that answer? And is it already secured? Too often, executives have never framed their project in these terms. Without a sequential testing process grounded in measurable facts, exploration becomes narrative-driven rather than data-driven. Investors must understand the roadmap before committing capital. A thesis is not enough. A methodology to validate it is essential.
I've watched a lot of countries, and I've watched a lot of official sector theft. What you learn, Danny, is that politicians will do what they think is in their interest. Specifically in the United States and Canada, elected politicians don't need to steal your IRA or your RRSP. And they don't need any longer to steal your physical gold. If they do that, it has real political risks for them. physical risks, even in the United States. There's 400 million guns in private circulation in the US, something that I think keeps the politicians more honest than they would admit. If they steal from you differently, however, if they steal from you by raising taxes, if they steal from you by artificially low interest rates, if they steal from you by inflation or the deterioration of the purchasing power of your dollars, those are all very popular with voters. So there is a reward to politicians for stealing from you indirectly, while there is a penalty to politicians for stealing from you directly. Now, with bank bail-ins, as an example, it is incumbent on people who deposit money in a bank to get from their bank something called a statement of financial condition. Banks are required to tell you how solvent that they are. Most people don't bother to obtain this information. Generally, if you read this bank's statement of financial condition, and the bank has, as an example, well, the FDIC says that 7% of the bank's assets has to be in liquid shareholders' equity, which is to say tangible equity, not intangible equity. But in addition to that, you should look for two numbers. Three numbers really. Last year's charge-offs, which is to say the money that they lost to credit risks last year, the amount of doubtful accounts they have or problematic accounts relative to total assets, and the reserves that they have established. What you will find is that high quality banks have reserve accounts established that often greatly exceed, their actual loss experience. They do that for two reasons. They do it to prudently shield themselves from credit risk, but they also do it to reduce their stated income over a period of time by establishing reserves with earning assets. If people want to avoid bank bail-ins, the best way to avoid bank bail-ins is to deposit their money or own shares in good as opposed to bad banks.
One of the most common investor mistakes is mismatching patience with process. Drilling programs in remote regions may require multiple seasons due to weather constraints. An 18-month timeline is not unusual, yet many investors expect meaningful results within weeks. Rule notes that speculation demands alignment between expected holding period and project duration. If you are unwilling to hold a stock long enough to receive a definitive outcome, your failure is almost guaranteed. Capital markets reward those who understand timelines. Exploration success is binary, a yes or no, but arriving at that answer requires endurance.
Sort of 7, I would suspect.
Mm.
I think people still, most people, when you do sentiment, you have to segregate between the silver bugs and the broad population. The broad population can't spell silver, so it's a non-entity to them. I would suspect that among the silver community, given the ongoing demand for retail silver products, which is to say 1 kilo physical or less, the sentiment's still pretty strong.
When asked about safeguarding wealth from government overreach, Rule draws a sharp distinction between direct seizure and indirect erosion. In developed economies, outright confiscation of retirement accounts is politically dangerous. More common are subtle methods: inflation, artificially suppressed interest rates, and higher taxation. These mechanisms reduce purchasing power gradually and often invisibly. For banking risk, he advises investors to review a bank's statement of financial condition, examining reserves, loan losses, and tangible equity. Bail-ins are less threatening at strong institutions. The solution is not paranoia, it is due diligence. Own quality banks, not vulnerable ones.
I think gold is probably a little higher. At least among investors, it's probably an 8. Particularly among the population that matters to the gold price, which is central banks. The central banks might not want to own gold, but they've learned they can't own US dollars. And so there's a major disintermediation out of US Treasury securities into gold. And I think that continues. So central bank sentiment around gold is very high. And they have been for the last 5 years the buyer that matters.
Copper?
Copper sentiment, I would suggest, is down around 5. Most people don't know that copper exists. For the speculators, they're bored by it. And the broad investing public hasn't caught on to natural resources at all. If you ask the broad investment public what they make of the supply deficit, which is to say consumption over production, most investors will say, "What's that?"
What about platinum?
Platinum, I would suspect, is a consequence of its price move. It's up at a 6. But again, you have to segregate between metals investors and the broad public. The broad public, for the whole range of extractive industries, with the exception of oil, which they just hate, have no opinion about it whatsoever. They don't care. If you ask a lot of people what platinum is used for, they don't know what catalytic converters are. They think, maybe if they're Japanese, they think that platinum is jewelry. The truth is that most people don't think about it at all.
Market sentiment fluctuates dramatically. Rule currently views gold sentiment as elevated, driven in part by central bank accumulation, while silver enthusiasm remains moderate. Copper and platinum attract limited public attention. Oil and gas, however, remain deeply unpopular, despite chronic underinvestment. Global sustaining capital expenditures trail what is required to maintain supply, creating long-term structural risk. With global oil demand exceeding 100 million barrels per day, production below full economic cost is unsustainable. Ultimately, Rule argues the most important question investors should ask is not about price, but education. Where can you learn more? Investment success begins with intellectual discipline.
3 at best. 3 at best. I mean, the narrative around oil and gas is improving, but not because of real reasons. It's improving because of news. People are trading news. News traders always lose. On the bear side, they think that Venezuela is going to start producing a bunch of oil. We're about $100 billion away from that. They believe that there's going to be peace between Russia and Ukraine. I hope they're right. And they believe that there's going to be a conflict in the Middle East. If it will impact sentiment as opposed to supply. The Iranian oil doesn't care who owns it. The Russian oil doesn't care who owns it. The Russian oil doesn't even care about U.S. sanctions over time. The Chinese will buy that oil. The Indians will buy that oil. The Turks will buy that oil. They might not buy it for a WTI price, but they'll buy the oil. What matters in oil is that on a global basis, we're underinvesting between $1 billion and $2 billion a day in sustaining capital. That matters. The eventual resumption of Venezuelan oil matters 6 or 7 years from now. If there were to be peace and the flow of Russian oil and gas unimpeded by sanctions, unimpeded by price, resumed, that would matter. That would truly matter. But based on the variables that we understand today, the only thing that matters is the utility offered up by oil and gas to users, which is huge, and the underinvestment in sustaining capital by producers. It is estimated that the total cost to produce a barrel of oil across all producers, efficient and inefficient, private and public, including the cost of capital, which the industry doesn't talk about, and also including social theft, which is to say royalty and taxes, that the total cost to produce a barrel of oil worldwide is about $60. That means as recently as 8 weeks ago, we were making the stuff at 60 and we were selling it for 52. We were losing $8 a barrel, 102 million times a day. That was fairly unpleasant. At $65 oil, the industry earns its cost of capital, but it doesn't earn enough money for new project investment. These prices are unsustainably low. If the oil price doesn't go up, Danny, by 2030, either the oil price will go up or your car won't start. And you need to decide which of those two outcomes is more likely.